Well, my hair might be short, but we're going long today. Let me pause the intro right there. Just explain real quickly. If you don't know, short means you're selling a position, long means you're buying a position. Probably already knew that, so let's continue with the intro and get this episode started. Hey everyone, and thanks for joining me today. My name is Matt, and the company that we're going to be taking a look at today is Docusign. So as always, I'd just like to start with a little overview about the company in case you're not familiar. So Docusign is a service that allows for you to sign legal documents or contracts electronically. They are also expanding into the business of managing contracts, but we'll talk more about that later. They currently have roughly 70% of the market when it comes to electronic signature services. The largest customer base that they have involves real estate, but you'll also see them involved with pharmaceuticals as well as financial institutions, and many other types of companies use Docusign. As of now, the biggest competition that Docusign faces is Adobe as well as Dropbox's service called Sign Easy. So we'll start off today talking about the highlights of the company. And I'll be honest, this episode is going to be less about the numbers because there's not a whole lot of numbers when it comes to like ratios or other things we typically use to analyze companies with Docusign. So it'll be more about their earnings calls, their performance, and the direction they're headed, as opposed to, again, those more analytical details about the company. So during the first quarter of this year, they added 68,000 new customers to their subscription service, which is a huge increase, but I think that's one that's pretty anticipated given that people aren't going out as much anymore, and the ability to sign documents electronically is not only more convenient for consumers, but it's also safer given current times. Again, we're in 2020, so that should be enough of a hint for you in case you watch this a year or two down the road. The 68,000 new customers that they got for their service is about a 43% increase from what we saw last year, and that seems to be a trend that Docusign has going on. It seems like this company is growing dramatically every single year and is getting large increases in the amount of people that are actually using their service. They now have a total customer base of around 661,000 customers. Admittedly, I thought they would have more customers than that, but it sounds like, given all the information that I was able to find, that is a large portion of customers. And again, that's about 70% of the entire market share, or TAM, when it comes to electronic signatures. Part of the reason too why they experienced a significant amount of growth during the first quarter of this year is because they actually partnered with the government when it comes to electronically signing documents for unemployment, as well as other smaller financial institutions or banks to help when it comes to loaning for either small businesses or personal loans to help them navigate uncertain times. So that definitely influenced the increase in their customer base. We might start to see a little bit of a slowdown with that increase in growth, given that they've already partnered with the government, but that's just something that time will tell, and one of those things that we'll just have to keep an eye on as we move forward. With the addition of new customers, they also experienced growth in their revenue. It was roughly an increase about 38% year over year, and this is a number that they anticipate will actually continue to grow again each new year that they have and performing. So it'll be interesting to see if they're able to maintain the steady and pretty large increase in both their customer base as well as their revenue. It is good to see though that they are able to increase their revenue over these years because they're not yet profitable. That's not something I'm totally concerned about because I think that their time will come pretty soon when they are profitable and they're growing and expanding their business line, but it'll just be interesting to watch how they're able to continue this growth that they've experienced. Probably the number that stood out to me the most from their earnings call was their net retention ratio, which was 119%, which is huge. Now, I found this explanation from Lighter Capital, which does a good job of explaining on how this could be over 100%. So let me just read that. I'll put it up on the screen so that can make a little bit more sense to you. Net revenue retention is the total revenue minus any revenue churn, which is basically people leaving the company or leaving Docusign for competition or downgrading the subscription level that they have, plus any revenue expansion from upgrades or cross-sells. So basically, the reason why that could be over 100% is because if essentially more people, let's say you start at like a $10 platform and the other options would be like 10, 20, 30. So they're having more people jump from either that $10 a month to $20 a month than people that are going from $20 a month to $10 a month. So that is how it could be over 100%. This is something that many companies strive to achieve, but unfortunately not many actually reach that 100%. So it's very impressive to see that not only were they able to reach 100%, they were able to exceed it, which clearly goes to show that this is a well-created product and there's clearly a need for it, and it's something that people enjoy using. They're not exploring other options. Instead, they're sticking with the company, and if anything, they're increasing the service that they're receiving and paying more so that they can have more options or a better level of service. Now, there was a few things that were not from the earnings call, but I just felt were numbers that are worth mentioning. So the first one is that they have a price to book ratio of 57. Basically, what price to book ratio is it is the market value of the company compared to their book value. So basically what that is the market value is going to be share price times your number of outstanding shares, and the book value is basically the net amount of assets that you have in a company. So the reason why we wouldn't use price earnings ratio for a company like Docusign is because they don't have earnings currently. So that would give us a negative PE ratio, which just doesn't really line up that well when it comes to valuation perspective. So we use something like a price to book ratio to see exactly, where they are to get a relative idea of valuation. Now, similarly to the PE ratio, that is still a very high percentage to see. That does mean that they're trading at a premium, but might not be something that we're too concerned about, given that this company clearly has a focus on what they're working with and has a large portion of the market share. There's also clearly a high demand for this product, so while that is high, it's not something that's going to steer me away from this investment. I also saw from Simply Wall Street, it looks like about 81% of their shares are owned by institutions. This is something that I like to see because that means that these shares are being put into a fund, usually. And that's something, again, I like to see because that means that the trading volume isn't going to be high. Sometimes trading volumes can have negative impacts on the actual price, or it can cause it to be a more volatile investment, kind of like what we've been seeing with the airline industry because of all the people trading it on Robinhood. So it's something I like to see, again, as a long-term investor. I'm not a frequent trader, so I don't like when trade volume can impact my investments. So with it being owned by institutions, generally these are things, again, you'll see in their funds, in their employer plans. Ultimately, it's going to be a position, though, that they're holding on to for at least a year. It's pretty uncommon for institutions when they buy these to put it into their funds, for them to hold on to it for less than a year. So there's two main things that stood out to me for the future of Docusign. The first one is that they are looking to utilize or incorporate blockchain technology into their service, which admittedly, I'm not an expert of blockchain technology. Knowing that it's kind of that universal, or it's a better auditing system, something along those lines, is good to hear. I believe that it has a way of keeping people more accountable. So again, not something I know a lot about, but I know it is something that they've been hitting on pretty frequently in either their TV interviews or during their earnings calls. So they do have a focus on incorporating blockchain technology into their services. The other thing is the Docusign Agreement Cloud, which really seems to be their biggest focus right now. And that's why we've actually seen, I know I didn't mention this earlier, but their expenses have been increasing because of their focus on this new service that they're providing. As they claim, this Docusign Agreement Cloud, and I'm just going to read this part from my screen here, says that it's used to prepare, act, sign, and manage documents or agreements. I had to kind of look into that and see exactly what that means, and I'll be honest, it's a little bit of a loose definition right now, so something we'll see with time. Basically, some of the features that this allows is, let's say you're like leasing an apartment, and you receive the contract, but you have questions on it. It lets you leave comments on the document itself, send it back to the person you'll be leasing from, and let them address the questions before you actually electronically sign for it. It also allows for people that have these documents to make easy adjustments to the contract themselves or add additional signatures, which is huge. I know when I worked in finance and I dealt with transfers of accounts, if somebody needed additional signature lines on the document that we had for them to transfer an account, It was not an easy process. I had to make photocopies, I had to make adjustments. So not only is this making it easier because it's already an online signature, but it gives you the ability to very easily add additional signers, which is something that I think that's going to be attractive to people that use this on a daily basis. Again, maybe something like a financial institution when it comes to signing up for accounts or even transferring them from other institutions. Now, what I don't know about this agreement cloud is if it'll actually be Docusign drafting these legal documents, if they're going to have lawyers draft these documents for everybody to use, or if it's just basically going to be a place for you to upload your own agreements, contracts, whatever you have, to their service, and then using Docusign to, again, make those adjustments, add signatures, all that good stuff. So that's something that I was a little bit curious to see and I couldn't really find an answer to. I know it's a whole legal thing when it comes to drafting documents, but could be worth the investment for them. So if I do get more information on that, I'll gladly make a quick update video on this. So now I just wanted to talk about what I do like about Docusign as an investment. And the first one is their single focus. So yes, they are incorporating this new service, the Docusign Agreement Cloud, but it still plays off well with the service they're already providing, which is the electronic signatures. I think this can be easily compared to when I say single focus, like a Zoom, who only does the video conferencing, or a Chewy, who only does pet supplies. I like that because I find when businesses can spread themselves too thin, they might end up making poor investments, or the quality of the service that they're providing can start to degrade simply because they're not putting all their efforts into one thing. Now, it's not always a good thing to be focused on that one thing, but when a product has such high demand, like electronic signatures, video conferencing, or food for your pet, then it makes sense to really focus on that one thing and do it extremely well, better than the competition. So, like the example here, Adobe. Now, Adobe, as I mentioned in my analysis of their stock, which is doing very well, is that they have the Creative Cloud, which allows for you to make videos, Photoshop, sound editing, everything. And they also have a new signature thing. So when you're spread that thin, it might create a little bit of problems when it comes to the performance of that service you're providing, where Docusign simply just focus on making this the best and easiest experience when it comes to signing and drafting legal documents. One of the big focuses too that I heard a lot from management during this earnings call is that they are very focused on their employee happiness, or having Docusign be a place where their employees enjoy working. Again, this is something that I find extremely beneficial when it comes to companies, because if employees enjoy going to work and they like the work they're doing and they feel they're actually creating value for other people, then I just feel they're going to perform better than somebody who hates their job, is miserable 5 days a week going into the office and doing whatever it is they do. So I do find, especially for companies that are relatively new in the stock market, I forgot what I was going to say. I just really feel that when employers are focused on the well-being of their employees, it creates a better product and service. It allows for them to act in more unison together, and ultimately not only enhances the employee experience of working for them, but also the consumer experience, knowing that if they need to call up and ask questions, they're getting somebody that's actually happy to be there and not just using this as a way for them to pay their bills. Another thing I like, and this is speculative or just simply my opinion, is I can almost see them being the band-aid of electronic signatures. Now, I don't mean just being a temporary solution to a bigger problem, but I mean as in the name itself. So Band-Aid is a brand name, but doesn't matter what brand you're using, we all call them Band-Aids. And I could almost see that happening with Docusign, where it can almost be a verb. You know, are you Docusigning this? Are you electronically signing this? So I think that those names, Docusign and e-signature, could almost go hand in hand, given the amount of customers or the amount of market share Docusign has, as well as being a leader in this area. And as we transition into a more remote environment, there's clearly going to be more demand and more need for something like a Docusign service. So it's definitely a company that's not going to go away anytime soon, and I'll be curious to see how they grow or how they're able to handle the extreme increase in demand of their service. Now, I do have a concern when it comes to investing with Docusign, but it really just has to do with the price per share. So as I previously mentioned, the shares are trading at a premium, and this company hit the market in early 2018 at about $45 a share. Full disclosure, I have owned shares in the past and I have sold out of them, so it's not a position I currently own. With them now trading upwards of $165 a share, I just feel that that's definitely a very high price for it. And, I looked at the analyst price targets here to get an idea as what analysts are thinking is a good price for this, and they range around $159. Again, still lower than the current share price, but they're anticipating, I think the high was $170 and the low is $100 per share. So it's a pretty wide range that we're working with here. And with it being just a few dollars short of the high price target, does give me a little bit of concern as to if this stock is overvalued right now. Now, admittedly, my thought process here is that this company has seen such significant growth recently that it is really hard to put a price on it. And do I think $165, whatever it's currently trading at, I'll pop that up on the screen so you can see the current market price. Do I think it's still worth it? I do. But I don't necessarily think it's the best time to put all of my money into it. So, full disclosure again, what I did is I've actually already purchased this in the portfolio. My computer still restarts for whatever reason when I start screen recording, so I already got that taken care of. And I'll pop that up on the screen as well so you can see what we purchased it at. But I only bought 15 shares. And reason being is because I originally planned on buying 30, but again, I still think that this is at a very high price. Now, I don't want to miss out on any future gains in this, so in case it does go to 180, 190 in the near future, at least we have some exposure, but we're not fully invested in case it does dial back a little bit and gets to around $100 a share. I'll say if it gets to about 120, 125 on the low end, then I'll probably add the additional 15 shares. If we get to like 140, I might buy 5 shares. And that's just kind of my thought process with this. Overall though, I think that this is a stock that is worth owning. Again, might not be something you go all in right away, but I do feel it's one of those that's a good time to just buy in portions because we're going to continue to see the increase in demand for something like Docusign. They're not going away anytime soon, and so we might as well try to get a little bit exposure now and then just kind of watch how everything else plays out for them. So I know this video is a little bit different here today, and I apologize for all the technical difficulties that I'm having with my computer and why I can't do my screen recording, but I hope that you enjoyed this video. If you did and you'd like to subscribe, that'd be super awesome of you, but you don't have to if you don't want to. If you liked this video and found it helpful, it'd be super cool if you'd again give it a thumbs up, and if you hated it, then give it a thumbs down. Well, you could be anywhere in the world and you're right here with me, and I really appreciate that. So thank you so much for taking the time out of your day to watch this video, but I will let you go ahead and enjoy the rest of your day.